Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters podcast. I have Sam Betts with me. Hey, Sam, how are you?
I'm doing great. Thank you for having me on, and I look forward to talking to you.
Absolutely. So Sam is a partner of Trinity Capital Group that is based in the Dallas-Fort Worth area. Sam's background is in financial services, state and local taxes, and real estate. He has been directly involved in the acquisition, rehabilitation, disposition, and management of over $75 million in multifamily and single-family real estate since 2009. So yeah, I am looking forward to this episode to learn more about what Sam does and his business does, as well as how they are creating value through operations and strategic planning. So welcome again, Sam.
Yes, thank you. And I'm excited to share with your audience some of my experiences and knowledge and hopefully help them learn more about the business or implement strategies at their properties.
Awesome. Tell us something interesting or funny about yourself, which we cannot guess.
I guess this question is always one I kind of debate in my head and not sure exactly which way to go, but since you're in the San Francisco area, one interesting thing that I love is I grew up playing baseball, and I'm trying to go to all the major league ballparks in the nation.
Oh, okay.
I've been to probably 22 out of the 30 or so I'm
nice.
Almost all the way there. But I think the Giants Stadium out in San Francisco is one of the prettiest and most unique stadiums that I've been to, and it's just a great ballpark for the city and obviously the Giants.
That's awesome. That's good to know, because that's the only ballpark stadium I have been to. So I'm happy that at least I have been to one of the best ones.
Yeah. You went to the best. Now you don't have to visit anymore.
That is funny. So when and how did you start investing in real estate?
I started investing, I guess, in 2009. I worked actually out of Los Angeles after undergrad, and I went to grad school. And after grad school and getting my MBA and an MS in personal financial planning, I started working at a consulting firm. And to be truthful, it wasn't what I enjoyed and envisioned 40-year career would be. So I almost went to grad school for real estate, and I started just researching, and I got into a group back in 2009, and I was a limited partner. And in the first project, I was a limited partner in a 208 unit complex in Dallas. And we bought it for, I think, 13 a door. And
oh, wow.
I mean, now, and it's in a great submarket, but within that submarket, there's pockets that aren't so great. And like we had gang shootings at the property and different things where it didn't perform as well as it should have. And from that experience, I started investing in single family on my own.
Okay.
And then I realized after about 20 properties, I couldn't scale it.
Right.
And I decided to start looking for small apartments, and I ran into one of my partners who I used to work with at a consulting firm, and he was doing the same thing, and that kind of led us down the path of partnering together. And we've been doing multifamily deals, acquisition and development since we looked for the first 2 years and couldn't really get anything. And then we decided to bring in a third partner to actually build apartments instead of buying them. And that all happened in 2016. So we've now have 482 units, and I'm about to be closing on another apartment deal in the Atlanta area. It was supposed to be yesterday, but now it's January 20th.
Got it. So, yeah, you mentioned about you started as limited partner, but and then you started investing in a single family, and that's awesome as well at that time in Dallas market. But why did you choose real estate, right? Even especially after even that experience, because a
Yeah.
lot of time, and people like you and I are more adventurous. We go even when my first investment did not work out, I still invested in real estate. Second time, third time, I continued. But
Yeah.
most of the people, right, when that happens to them, they're like, okay, I'm not going to do it anymore. So what was the reason?
I think there's two driving factors. The first factor was when I worked in LA, I worked as an investment analyst at UBS, and I saw firsthand that I had absolutely no control over the stock market.
Right.
And what, yeah, and whatever the CEO of Coke or Pepsi, or if there's an event that happens in Asia or Europe, it affects the stock price, even though it could be the perfect stock, it could change. And I'm more, I hate to admit this, but I'm somewhat of a control freak. And
Right.
I learned through real estate, I won't say 100% of what I do or the profit or whatever is in my control. I know there's market forces, obviously, but I can control how the asset performs better than I can any other investment vehicle.
And the couple of good points you mentioned there. So control freaks are risk takers, right? Because they will take risk so that they can control, right? And that's very
Yeah,
important because most of the people when they are in W-2 job, they're laid back, they are comfortable in their job, and they don't want to take any risk, right? And second thing,
yeah,
when you spoke my language, I keep telling people, and of course, stock market is at all-time high right now. And my friends, when I speak with them about real estate, they're like, "Why would we invest in real estate? Look at what this is doing." And I look back, and when Brexit happened, in one night, my portfolio was like 20% down, right? And that was not just
exactly.
US, entire world. And then it did not matter even in SPY or in Tesla stocks or whatnot, right? So there is nothing. You can pick as many stocks you can do, or as coming from someone like you who has been an investment analyst, the person who knows the inside, means you cannot control, right? Means you cannot ask Tim Cook to start developing something for Apple, right?
Yeah, and you hit the nail on the head with Brexit, and even with COVID, the market
Yes.
plunged 30, 40%.
Yeah.
And now it's back, and we don't know exactly where it's going. And I'm not saying people should have zero uh, of their portfolio in stocks. I think everybody should be diversified,
Yes.
and I think real estate plays a part of that. But I lean more towards the real estate side than stocks and bonds. And um, like when COVID happened and the markets tanked 40%, real estate, if you weren't a REIT, if you were just an individually owned property, your value really didn't change.
Right. Yeah.
Um, so I think it's a great asset. It's backed by, it's a hard asset, and everybody has to have a place to live.
Yeah.
Obviously, depending on where you live, the markets are changing and people are migrating to different cities and states, but still everybody has to have a place to live, and there's a needed supply that the demand is not going to be meeting over the next 10 years. So I think it's a great asset class to own.
Right. Yeah. Which we don't build land, right? Of course, you have to, when you are going through due diligence, you figure out the market. But real estate is here to stay, and because it's an illiquid asset, the prices don't change overnight. Right? You
Right.
can't go to
Exactly.
Zillow and say, "Oh, my $100,000 or $100 million property turned into 50 million. I got to sell tomorrow." Right? That's not happening. So,
Yeah.
okay. So let's go. How do you create value through operations? What exactly do you do when you are going through, transitioning to your own asset management?
I, yeah, I mean, that's a very broad-based question. There's a million different things you can do to increase value, but mainly we'll go in and with acquisitions, we go in and renovate, make the unit nice, kind of like a house flip, but on a lot greater scale, and just make it nice for the residents, increase rent. I think with the property management companies we use, I've talked to every regional at least once a week, usually emailing 2-3 times a day to figure out how to best implement strategies. One of the things on this Atlanta acquisition that I decided to do, we were supposed to close at the end of last year, and I have a background in taxes and property taxes, and I know that in Atlanta or in the state of Georgia, assessment dates 1/1 of each year, and they're disclosure states. So if we close before the end of last year, our property taxes for 2021, we're going to probably match what our purchase price is. And just by closing in January, we're reducing the value significantly from what it should be, because it's going to be, it's on the tax roll right now about 2/3 of what we're paying for it. So in the first year of operations, we're saving 100,000,
Oh, wow. Okay.
115,000 possibly on property taxes, which is astronomical when you add a cap rate to it.
Right. So that is very interesting. So you are saying if you would have closed end of December, then the assessor would have assessed the property
Yeah.
in 2021. Now that as you are closing in 2021 in January, you have basically 11-12 months of gain from property tax perspective, or at least you are reducing the tax payments, right?
Yes, exactly. We increase cash flow in year one, which is great because it's going to be a large renovation. So
Oh, okay.
our cash flow might struggle a little bit, or it won't struggle, but it just won't be as high as it will be once the renovations are completed. So every dollar we can save is just added to the bottom line. And every state is a little different, but you can do that if you learn your property tax code and tax laws on, and timing of when you buy the property or not.
Right. So another question I have, because you had background with taxes, but do you also have a CPA or a tax attorney in your team who helps you guide through or should someone have a CPA as well as tax attorney while they're going through a transaction?
Yeah, I don't have a CPA, but I worked in state and local taxes for 10 years. So I know property taxes, sales taxes, and excise and fuel taxes really well. So from a real estate side, we don't really need to bring in a CPA. One of my partners, he is a CPA,
Okay.
so he helps from that way. But I would highly recommend people that are either going through due diligence, that if they don't understand taxes, to bring in a CPA, or you'd need one on your team just for books and for all the tax returns and K1s that you have to file on a yearly basis.
Got it. And what are other ways? So I want to talk about creating value through operations. And as you mentioned, adding or let's say switching or putting new light switches or USB ports, etc. How do you compare? So when you're going through those kind of innovations, what do you do to figure out if this will be worth something, or would this create or would this help you increase the rent or not, right? So how do you figure that out?
We use two different ways. I think some markets can tell you a lot. If there's a lot of comps in the market that have done it and have proven that strategy, that's a great way. But also it's just testing. And yes, it's very important to increase value. And if you can make it a smart apartment, which a lot of operators are doing in Texas, and you can
Right.
$30 to $50 more a month, that's great. But also the main determinant of value is your NOI. So if you can reduce expenses, I mean, that's just as good as adding value or increasing your rent. So on some properties we'll go in and we'll get a green loan with Freddie or
Right.
sorry, Fannie. And I mean, one property we bought in September of 19 and we went through the green process and we're reducing utilities by over 30%. And that just helps us. It reduces the residents'
Right.
utility spend for each month, and then we can increase the rent and offset the savings they get from the utilities.
So can you explain my listeners what is a green loan and how
Yes.
do you get one?
A green loan is basically a loan that Fannie Mae does, and it incentivizes people to make older properties more efficient.
Okay.
And you have to go through, they bring in engineers, they do their studies. You have to save 30% of utility expense to get the green loan. And it's usually 15% water, 15% electricity. And there's a lot of different ways to get to that number. It's by changing out toilets, it's by putting in aerators and faucets.
Right.
We had to change out thermostats in our office, and then a couple of the open shared rooms like the gym and things like that. We had to wrap our hot water heaters with a liner to make it more efficient. It's
Right.
just
Okay.
trying to help the environment and reduce energy costs across the board.
So another question on that. Can you provide us numbers? Like, so let's say you had the property and you already have a first loan, right? So the green
Yes.
loan would be a second loan or supplemental, something like that?
Yeah, actually, with Fannie Mae, it's all in one,
Oh,
and
okay.
they'll finance the green renovations. You can, with other lenders, bring in a second loan. There's different programs that do it
Got it.
and different interest rates, but the green program with Fannie is so great is because the dollars to finance the renovations are at the interest rate of your property, and like they incentivize you to get the green loans. So our interest rate, and back in 19, our broker told us this was the best rate ever gotten anybody, and it was a 3.44% rate.
Wow.
Now you're seeing sub 3,
Right. Yeah.
but at the time
Yeah,
it
at
was the
that time
best.
I can tell. Yeah, of
Yeah,
course. Right now is
yeah,
a different story.
yeah.
When we are printing so much money, we have to keep the interest rate low. Otherwise, we
I
cannot
know.
afford to pay our debt, right?
Yeah. I don't know if this is true or not, but I heard the other day that we printed more, or 2/3 of the amount of money the U.S. has printed was last year compared to the money it's printed from 2019 all the way back to 1776.
Yeah, I think that's what I heard too. That makes sense. Because if you,
Yeah.
and on top of that, we had another stimulus end of the year, which
Yeah.
got approved, right? 900 billion plus the omnibus bill. So again, I'm tired of talking about it. So, and anything else from strategic planning you do to help increase the value of the property?
Yeah, I think there's no one set strategy we go after. It depends on the market, it depends on the property, it depends on tenants, just a lot of things. When I was in tax, state and local taxes, they always had the acronym DOTS, which is depends on the state. And
Right.
I feel like it's kind of the same. You can't just use um, one strategy to be a blanket strategy, because like, for instance, some of our properties, we're now starting to go in and provide internet to all of our residents, and then we pay a cost to a provider, then we bill the residents and we create a spread. And some of our properties, they won't accept that.
Right.
So it just depends. But
So, are you using something like Giga5 for that? Because I know
no,
that's another one company. I met them
yeah,
in Dallas itself at one of the conference. And
yeah, I know Gigafy is really big. Luckily, and I don't know if it's just kind of a special that Spectrum did or what, but
oh, Okay.
The property we acquired in 19, the previous owner just worked out a deal with Spectrum for internet and cable, and we're giving the residents internet and cable for cheaper than what I pay Spectrum personally for my internet.
Right.
So it's a win-win situation. For another property, we're talking to a vendor who was or is a multifamily operator, but now they've started a management company and they've started a communication company, and we're talking with them to go in and install fiber throughout the complex, and we can either pay for the infrastructure up front and then we don't pay a monthly fee, or they can install the infrastructure and then we pay a monthly fee and then bill back the residents whatever we feel like is a accurate and fair rate for the electricity.
Got it. And I don't want to, throw a curveball, but I just started thinking when you spoke about it and when I even met with GigaFi. On one hand, as multifamily and I'm a mobile home park operator, we want to move most of the cost or the expenses on the tenant side, right? So whenever we look at master water meter, we are like, oh yeah, we got to have individual water meter. So
Yeah.
how is this helpful? Moving internet or something like that from individual to master internet. Of course, you can create a spread and make increase the NOI. But is this actually better than taking more responsibility? Because whenever we buy acquire
Uh,
property, we want to go the other way, right?
that's a really good question, and that's what goes back to saying it depends on the property.
Okay.
When we bought this property, it was owned by a hotel operator, and
Ah,
they treated it like a hotel. They paid for absolutely everything, even cable.
oh wow.
They paid for cable, so they they didn't pay for internet, which was the only expense or utility that the residents had to pay for themselves, and they were giving it away for free. So we came in, and as leases expired, we put in, we call it a RUBS fee, but
Right.
it was significant because we weren't going to pay for all their electricity, all their cable, all
Right.
their water. So we think it's really easy just to add that on to the RUB fee. Obviously, it's going to take time and leases to expire, but we think we're going to add value to them, and it's going to make it an easier, seamless process because they aren't having to get they aren't having to call an internet company to get internet. They aren't having to be screened to see if they're credit worthy to get internet. It's a probably blue collar workforce, so I don't think many people would have issues with their credit, but you never know.
Right. And does it create nightmare for you to manage that kind of service? Like now they are not calling Spectrum, but they will be calling property management company. Do you have
But
added, cost?
yeah, I mean, I think time will tell since we haven't implemented and we're in the process of doing
Okay.
it. But from my understanding, it's not even a switch once they move in. It's just there, and they log on, and it's instantaneously there. So I don't think it's going to be an administrative burden. If it is, then maybe we'll add a $25 fee or something. But I mean, Spectrum, AT&T, all your internet providers, they charge those type of fees anyways.
Right.
So would be cheaper than what Spectrum or another vendor would provide.
Got it. Hey, so let's talk about new construction because that was one of the thing I wanted to figure
Yeah.
out. So did you start with new construction from as soon as you started real estate syndication, or that came afterwards?
The first syndication I was a GP on was new construction. And go ahead. I'm
No,
sorry.
no. So I sorry to interrupt. So why was that, and why did you choose to be a GP in a new construction?
Well, I think it was just, I felt like we were banging our head for 2 years and going down the same path and not getting a different result. And from 14 to 16, we tried to buy acquisitions, and either the brokers told us we didn't have any experience and they didn't take us seriously, because at that time my partner was in his 20s. I was late 20s, early 30s, something like that. And they just didn't trust us to close. And in 14, people were saying, well, the market's going to correct in a year or two anyways. So we were underwriting very conservatively. And after about a year and a half, we started brainstorming. We're like, how can we do this an easier way? And my partner knew a guy who had been in construction since the 90s. And we asked him if he had built apartments or retail or any type of commercial assets. And he had, and he actually had some land where he was building out a retail space for Keller Williams and Anytime Fitness, but he didn't understand syndication. He didn't know how to raise money. He had never heard of that before. So we told him we can come in, do that aspect if you handle the building. And that project was really successful, and it just kind of led from there.
That's awesome. So, can we talk about your best real estate deal so far?
Okay. I guess I'll use, since we talked about the first one, we still have the apartment, but it was a mixed use development, and we sold the 10,000 square foot retail space after 16 months. And we were planning on holding it for 5 to 7 years as a triple net lease, good quality tenants. But we got an offer where we were able to return 41% IRR to the investors on that portion of the syndication. So we felt like it was a no-brainer.
Right, that's great.
Yeah, and it was a good way to establish a track record. Honestly, the first equity raise, like I'm sure for everybody, is the most difficult. Yes. And especially being new construction, we had to raise like 2.2 million or so, and it was very hard. But after we proved that we could do it, we showed investors returns that we had already actually achieved. It's made the capital raise process a lot easier.
Oh, yeah. I think it definitely helps when you have a closed cycle, right? When you have gone through a cycle and show that this is what we have returned, right? That's huge.
And that's actually on all the developments, since they're brand new, our strategy has been to build, refi, hold long term. Yep. And I'm trying to get into institutional capital and family offices, and that's been one of the issues we've had, is they want deals to go full cycle.
Yes.
And all of our apartments we still own and hold, and we plan on holding for a long time. So there's definitely like showing a proven plan, and it just helps investors gain a lot of confidence in your abilities.
Oh, that's great. Can you talk about, or if you had a worst real estate deal, can you talk about it and what did you learn from it?
Yeah. The worst real estate deal I had was actually single family. It wasn't a syndication. I was at a consulting company working probably 60 hours a week, and I was trying to do 4 flips at one time.
Oh.
And I didn't have time to be a GC on it, so I outsourced it to a GC. And we met. He seemed great. I gave him, I don't know, 30 to 40% of the down payment. He started doing the work. He asked me for more. I gave him more, and then after that, I never heard from him again.
I've heard this story before.
Yeah.
It's like a recurring theme with almost everyone.
Yeah. So I lost with like what he took, plus bringing in a contractor to do the work that he didn't do correctly. I lost like 40,000 or so. Wow. And that was a hard lesson and a hard pill to swallow. But I won't say it was beneficial, but it just helped me, and it helped me become more skeptical, and just showed me that I needed to be more hands-on again. When I wasn't hands-on, it didn't turn out to how it should have or how it optimally could have. And I became a lot more skeptical of contractors since then.
Oh, that's great. So let's take a quick break, Sam, and after the break, I'll go through the 5 questions I ask every guest on the podcast.
Okay.
You're listening to the Wealth Matters Podcast.
The Wealth Matters Podcast.
For more info about what we do, check us out at wealthmatters.com. It's wealth, WEALTH, matters, MATRS.com.
Welcome back to Wealth Matters Podcast. We are chatting with Sam about how he got into real estate and how they create value through operations and strategic planning. Sam, are you ready for fire round?
Sure, I am. I'm looking forward to it, Alpesh.
Let's go. Would you be changing any business or investment strategy after coronavirus?
I don't know if I'd be changing, but I'm always flexible and open to different strategies. I mean, I feel like I'm asset class agnostic, and we've invested in a lot of different areas. So I've always just looked for the best return for our investors and for myself.
Favorite real estate or finance or any other related book?
Oh, there's so many great ones to pick from. I think finance or real estate related, I would say Sam Zell's Don't Be Too Subtle.
Yes.
That title might be a little off.
No, Don't Be Too Subtle. That's a great book.
Yeah, I read it a couple years ago and thought it was phenomenal, and just seeing his story and how, I mean, he's been so successful over decades. I would love to get to that point.
That's great. Any tool or website you recommend or you cannot live without?
Excel is definitely
a financial analyst. I forgot that. Investment.
Unfortunately, I spend probably more time in Excel than I want. But there's a lot of great websites. One I've started using more and more is censusreporter.org. I've used other census websites in the past, but I feel like you can drill down into more detail and get to a smaller area than you can with a lot of the websites. So I started using that the last couple of months.
And this is an important question for the podcast. Any advice for beginner investors?
If I had to start all over, I think the two biggest takeaways or two biggest areas of focus I would go down is learn as much as possible, be vigilant in your reading and networking, just talking to people and building out your network as large as you can. It truly is true. Your net worth is your network, and the more people you know, the more deals you might be able to get, the more investors you might be able to bring in. So just knowledge and networking is vital.
Thank you so much for sharing that. How do you give back?
I give back several ways. I'm a Christian, so I tithe to my church. I'm also a part of several organizations in Dallas that focuses on the city of Dallas. And then I've went on mission trips with a microfinance organization to Africa, and they're doing some amazing things with microfinance and loans. And I like to give back that way. And then I will help people in real estate if they have questions, or some of the limited partners I've had have become general partners, and they've always had a lot of questions on different things that they weren't sure about.
That's great. How can my listeners reach out to you?
Yes, you can call me at 972-855-7654, or you can email me at sam@trinitycapitaltexas.com. I am on social media. I just don't check it as often as some do. So email or phone's probably the best way.
Okay, awesome. Thank you so much, Sam. I definitely had a lot of fun and, of course, learned a lot, especially the green program, property tax. So yeah, looking forward to staying connected.
Yes, definitely. Thank you, Alpesh, for having me on, and I look forward to talking to you again.
Have a great weekend. Bye.
Thank you, you too.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!